the price of these loans are being raised, and they can't service it because they've leveraged. So they're getting out of their short yen. They're covering the yen. The yen is rising as well. And they're having to liquidate their riskier assets, stocks and bonds. So it's a cocktail for disaster. And that's why I've been covering the yen carry trade for years, because I knew that eventually it would be part of the whole, let's say, blow up mechanism of the whole fiat currency system that we're under. And I'm adding also US Treasuries, because it's a huge pile of debt. It's like 29 trillion held by the public. The rest is held by the Federal Reserve. And Thursday, May 22nd, 2025, Maneco 64, home of alternative economics and contrarian views. So debt, it's the debt, right? It's the whole problem with this fiat currency system. And it looks like after 25 or 30 years of money printing by the central banks, government, heavy government spending, deficit spending, the debt pile is starting to wobble really badly. It's a $300 trillion plus, not counting, of course, the 1,000 trillion or even more of notional derivatives out there. It's a mess. And we're seeing the US Treasury market wobble, the Japanese government bond wobble, and those two are at the heart of the system. So that's what we're going to look at today. There were some interesting developments yesterday and in the previous days in Japan. I'm going to go briefly through what the Japanese yen carry trade is. I've been covering it for years here on the channel. I even have a playlist on it, and you can access it here to go through the content and try to understand more better what it is. But I'm going to try to give you a very brief summary of what it is. Before we go further, though, I like to give a shout out to a few of my affiliates. First one is Dirty Man Safe. So Dirty Man Safe is underground safe solutions to securely store your valuables, like sporting goods, like baseball cards, collectors, precious metals, cash, jewelry, electronics, documents, even crypto passwords, with confidence. So if you want to check them out, there's a link below in the description. And if you were to purchase a Dirty Man Safe, you'd get a 10% discount using my link. And I'd like to also give a shout out to my precious metals dealers affiliates in the US. It's Miles Franklin. All the details are below in the description. If you get in touch with them, tell them that Mario or Maneco 64 sent you there. The other one in the UK is Gold Investments. All the details are below in the description. And yes, let's get back to the government bond market, treasury market, JGB market. Even the gilt market is not looking good here in the UK, but we're going to cover the biggest bond markets in the world, the US Treasury market and the JGB. And a lot of you know that I worked as a government bond futures and options broker for 20 years in the City of London. My clients were institutional clients, like banks, hedge funds, mutual funds from all over the world. So the bond market is a specialized market. Some people call it, that's where the smart money really gravitates to. And I'm not trying to be arrogant or anything, but that's the way it is. The stock market is a lot smaller than the bond market. And why is the bond market, especially the government bond market, so important? Well, because it's at the base of the system. If you look at John Exter's inverted pyramid here, government bonds are just above cash and gold, of course. But Yeah, I remember very well that when we had U.S. Treasury auctions, that's when the U.S. Treasury sells new debt to the market. The results used to come out just after 6 p.m. London or 1 p.m. Eastern Time. And back then, the auctions weren't as regular as they were now because there wasn't as much debt to issue. But I used to stay sometimes past 6 o'clock to cover, to look at how the results came out. And I had to call a few clients to tell them what happened because it could have affected their positions. So I remember well staying past the time that I usually stayed in the office still to cover these auctions. So yesterday, all of a sudden the market started moving. I didn't look to see what time it was. And then an hour or so later, I realized that there was a 20-year Treasury bond auction. And the 20-year is not a very common maturity. I think they used to issue it back in the 80s. They stopped. They're issuing it again. But nonetheless, the results weren't very good. Like something called the bid to cover ratio was a lot lower than the average of the last 10, for example. What is the bid to cover ratio? Well, if the Treasury is going to issue, let's say, $10 billion of 20-year bonds, and there are 10 billion in bids from the primary dealers, from investors, the bid to cover ratio is 1-to-1. 10 billion offered, 10 billion bid. So you can see how a failed auction basically would be when you have a bid to cover ratio below 1. And it wasn't the case yesterday. It's still around 2.46. That's what it was yesterday. And apparently, though, the primary dealers who are forced to step in when there isn't enough bids out there, they came in, they were forced to come in. Their bids were like almost 20% up from 16%. And the markets look at that. So in a nutshell, it was an auction that didn't go very well. And at the same time, we're seeing all the debate around the very nice big budget, the big beautiful bill. For example, Thomas Massey, the Republican congressman from Kentucky, he posted yesterday and he said, here's a sign of what's in store if the big beautiful bill passes. Congress can do fantasy math, but when investors put money on the line, the math gets real. Bond markets are already demanding higher returns because Congress isn't serious. The Fed no longer controls rates. So what happened yesterday afternoon, US time, is that it wasn't a very good 20-year auction. And then the 10-year yield and the 30-year yield rose as well. As a result, bond prices dropped. So the 10-year yield right now is at 460. I think the high yesterday was 460. I've been telling you about that 480 level. We're still not there, but even worse, the 30-year went up to like 5.12 or 5.1. Right now it's at 5.1, so it's going above 5%. And what that did, at the same time that bonds dropped and yields rose, the stock market dumped. And that's because the price of credit, which is derived from the cost that Uncle Sam has to pay for credit, because Uncle Sam is considered the safest credit out there. Well, that reflects on discount rates for valuing stocks. And that's why the Dow dropped 800 points, almost 2%. S&P dropped 95 points or 1.6%. And the NASDAQ dropped 1.4% or 270 points. And what about Japan? Well, let's start with the yen carry trade. Basically, the yen carry trade in a nutshell is this. the Bank of Japan and the Japanese government, they've conspired to keep borrowing costs at zero or even negative in the past 25 years. And what that has resulted in is in investors, speculators, hedge funds going out there, borrowing in yen, taking the proceeds in their currencies, let's say dollars, pounds, euros, Australian dollars, and buying higher yielding assets and doing it with leverage because they thought Japanese rates were going to stay low forever because that's what the Japanese officials kept saying. And don't forget, the Bank of Japan owns almost half of all the government bonds, and the debt to GDP ratio in Japan, the government debt to GDP, is almost 300%. But now, unfortunately, for Japan, interest rates have started rising. And that's a huge problem, not just for Japan and the BOJ and the government, but for those people out there who abuse this cheapness of borrowing by doing this carry trade. Because what's happening now is that their loans might be coming due, or they're getting margin calls because these loans are, the price of these loans are being raised, and they can't service it because they've leveraged. So they're getting out of their short yen, they're covering the yen. The yen is rising as well, and they're having to liquidate their riskier assets, stocks and bonds. So it's a cocktail for disaster, and that's why I've been covering the yen carry trade for years, because I knew that eventually it would be part of the whole, let's say, blow up mechanism of the whole fiat currency system that we're under. And I'm adding also US Treasuries because it's a huge pile of debt. It's like 29 trillion held by the public. The rest is held by the Federal Reserve and might be even more going forward, because I think that's the only way they can save the system, is for the Fed to start buying more, printing more money to buy more treasuries. But so that's what's going on in Japan. We had a mini crisis, quite a big crisis actually, last August, when the yen appreciated a lot. Interest rates are going up in Japan, and I think the Nikkei dropped like over 10% in one day. That was on August 5th. I remember that day well. And then things calmed down. But now, if you look at the chart of the dollar yen, that's going down, which means the yen is appreciating. And I had a look at the Japanese, for example, 40-year government bond yield. That's going through the roof. Like today is at 363. We started, let's say, the year at around 2.6%. So it's gone up 1%, 1 whole percent, which is huge. Just to give you an example, up until, let's say, 2019, that 40-year government bond was yielding a negative yield, which is crazy. And the BOJ, of course, owns half of all the government bonds. And what that's doing right now for the markets, because I've looked at the yields in Japan and they're all over the place, is that it's a very illiquid market because there's not many owners. One entity, the Bank of Japan, owns everything, and they're not very active. They're just going to hold on to these government bonds because they can wait forever. When they mature, they'll get the par value. Of course, if you look at the price of gold in Japanese yen, the Japanese yen is collapsing in terms of gold, and the same thing is going to happen to the dollar and all other fiat currencies. And the same thing is happening to the 10-year JGB yield. We're already almost at 1.55. So that's going up really quickly. So that old saying from a passage in one of Hemingway's novels, the guy asked another guy, how did you go bankrupt? He said, gradually and then suddenly. And I've said this a few times, and I'm saying it again. I think it could become sudden, and we could see central banks react. And how do they react? Well, they react in the only way they know how to, and that's to print, well, technically it's central bank reserves out of thin air. It's not really money or currency, but let's say it's money. And what they will do with that, it will increase their balance sheets, and they'll be buying the government bonds to keep the yields lower, to keep the debt bubble from imploding. We're in interesting times, and it could get really wild out there. So what do you do in this situation? And it's something that's never happened before with the major reserve currencies. And I say currencies with an S because the Japanese yen is a major reserve currency, not the biggest one like the dollar. And it's one of the reasons why the yen carry trade has been so popular, because it's a deep, liquid, open market in Japan. And so is the euro and the pound and the Aussie dollar, Canadian dollar. So all these currencies are going to be in trouble. What am I doing? Well, I'm holding on to my physical gold and silver, of course. I do have mining stocks, and they're going to get volatile. I expect them to do well, to come out of this well. What about the major stock market? If you have a 401k or you have a private pension in the UK, what do you do? Like a SIP? Well, I don't think you should panic. What I hope you've done is that you have some gold as insurance, because if you see a lot of volatility, if you see a sharp drop in your pension pot, gold will compensate for that and will balance things out. I'm not saying you should just sell everything and just buy gold, even though I would have done it years ago. But, so the other thing that's going on, and I've spoken about this, is we have to look at the ratio between the price of gold and the price of the US 10-year note or bond. Yes, the 10-year is called a note. Yes, it's a bond, but technically they call it a note. The 20-year and the 30-year, they're called bonds. Anything below 2 years is called a bill. From 2 years to 10 years, they're notes. But I've shown you this chart before, to those of you who've been around. Maybe for the freshly minted new viewers, you haven't seen this, but basically this is the price of gold in terms of the US 10-year note. And you can see that this is a monthly chart. It's picking up and it's almost at an all-time high. So what this means is that, yes, the Fed can step in, the JGB can step in and start printing and keeping rates under control, keeping the government bond yields under control. But what will happen is the price of gold will go up a lot quicker than the price of these securities. And as you can see, we've been in a bull market since the beginning of the century, a bull market in real money, in gold versus paper. So all those people out there who say it's safe to be in treasuries or JGBs, they could be right in that the government will always print and pay you, but they're going to print and pay you with paper or currency that is buying a lot less. And that's why gold is so important, in my opinion. And you can do this exercise for all other government bonds, and you see that gold is trouncing every government bond. And eventually, we're going to see all the liquidity, or a lot of the liquidity, crash through John Exter's inverted pyramid. That will be when the system breaks down and something new emerges. And that something new, of course, will have gold and silver in it as a lot more important. And talking about the importance of gold and silver, there's been some posts here on X. For example, Gold Telegraph 7 hours ago said the European Central Bank is warning that a fundamental regime shift could be underway as investors rethink United States assets. So when the dollar is like in doubt, the faith and confidence in the dollar is in doubt, there's only one real asset that comes to mind, at least to me, and that's gold. Gold Telegraph had a really good post, and if you're on X, I recommend you follow Gold Telegraph. He said, Japan printed itself into a corner. Now the world is watching its bond market and pretending to be shocked. What did you expect when the central bank owned over half the debt? Why is this so hard to understand? And unfortunately, I think the Fed might go down the same road of the Bank of Japan. We'll have to wait and see. So it's 7:24 a.m. London time. Spot gold is at 33.29. The high's been 33.45. So we're up about $14, the spot price. Silver is up 13 cents at 33.50. The high has been 72. And it was encouraging, of course, because yesterday gold and silver rallied strongly with stocks and bonds really doing badly. And that's how it should be. So the stock market hasn't really had a dead cat bounce. It's had a little meow, I would say, right now. The Dow is only up 25 points. The NASDAQ 100 is up 43, and the S&P is up 10. Currency-wise, keep an eye on the dollar yen. I'll show you the chart of the dollar yen here. The lower this chart goes, the worse it is. It means the yen is strengthening and it's wrecking the yen carry trade. When the yen carry trade is wrecked, speculators, investors need to bail and need to sell assets and cover their yen shorts. You can see that last year, 2024, from July 1st to August 5th, the yen went down in an almost straight line, and that's when we had the problems. Right now, it's just starting. Well, not the yen started to go down. Sorry, the dollars went down and the yen went up in a straight line. Right now, it looks like we're just starting. Yeah, so with that, I'm going to wish you all a very good day. Take care. Bye.